Welcome, everybody, to Beyond the Crisis, where we explore what the future holds when we get back to quote unquote normal, whatever that looks like after the crisis. And kind of most importantly in this interview series, how we can actually use this crisis to accelerate the progress we're trying to make in our life, with work, and with our finances as well. So I'm fortunate to have today Tim Dewey as my guest. Tim's a professor of practice at the University of Oregon. I won't hold that against him as a Oregon State graduate, but he's a senior director also of the Oregon Economic Forum. So in addition to all that, he's a highly respected observer and commentator on what the Federal Reserve is doing. And he writes a regular column for Bloomberg, and he maintains his own blog, the FedWatch blog. And I would highly recommend that. It's been a great follow for me to keep tabs on everything the Federal Reserve is doing throughout this crisis. So if you're interested, I would go ahead and follow and subscribe to his blog. So I'm interested to talk to Tim today, get his take on all the stimulus that we've done so far and his thoughts on kind of where we are and how this crisis plays out. Some of the questions we're getting that we plan to get into here are, aren't we bound to get inflation, and how are we gonna pay for all this stimulus that we're doing? So excited to get into that. And we're also gonna talk about what Tim sees in terms of more risk or more opportunity from here in terms of where the economy is positioned. So with all that, welcome, Tim.
Thank you very much for having me, Isaac.
Yeah, thanks again for being here. So my first question is, we've done roughly $6 trillion of stimulus. Some of that actions by the Congress in terms of the CARES Act, some of that's actions by the Federal Reserve. How necessary, I guess, would be my first question, is all that stimulus that we've done so far?
Well, I think it was critical, certainly on the front end of this crisis, to basically fill what was really a massive hole that we left behind. We had never really shut down the economy in such a way before, and so there was a rush to start plugging holes as fast as we could. And I think that was the right thing to do. Certainly at that time. So, this is going to be one of those situations that if you don't look back on it and think maybe you spent a little bit more money than you had to, you probably weren't doing it right. And I think that, now in retrospect, it's fairly clear that demand, for consumer products did not drop off as much as might have been anticipated, given that we shut everything down for as long as we did. And I think you do tie that back to the stimulus monies.
Yeah. So I want to get into, one of the things you said there was definitely necessary at the outset to kind of get in front of this. So I want to get into later just where are we now and kind of what's needed going forward from your perspective. But maybe before we get into that, maybe if you could just back up, because a lot of the questions that we get are around the Federal Reserve and what they're doing and money printing and things like that. So can we just back up and maybe break down some of the different actions that the Federal Reserve is doing, and how do those actually impact the real economy? So, they're buying corporate bonds, they've lowered the interest rates. Maybe if you could just kind of break down the actions, and then how does that affect the day-to-day economy that everybody's familiar with?
Right. Okay. So one way to think about it is essentially in order. The Fed first cut interest rates to basically zero, for all intents and purposes, and signaled that they would be at very low rates for a long period of time. And so that locks down short-term interest rates. It also puts downward pressure on longer-term interest rates. Right? So that was certainly one early action. Another was expanding the pace of large-scale asset purchases. And initially, at least the argument there was that financial markets were not functioning properly, and they weren't functioning properly because they had a lack of accessible cash. And so basically the Federal Reserve was providing cash into those markets in order to make sure that they were effectively functioning. Right? So that's another layer, the large scale of asset purchases. And then another layer is these lending programs the Federal Reserve developed, right? And the goal of the lending programs is essentially to unfreeze credit markets or jump over any frozen credit markets to ensure that firms and households, initially firms, later households, but also state municipalities could still borrow in this environment. So again, that was an issue that was originally directed toward market functioning type issues. Now, presumably when market functioning was restored, as it largely has been, many of these programs wouldn't have as much effectiveness or wouldn't have as much use, and some of them have had low take up. We have seen some municipal debt issuance through the Muni program. State of Illinois and the New York Metro Transit Authority both tapped into that facility. The take up on the Main Street lending program has been a little bit low, and I think that's essentially a reality of that firms that probably can borrow, can probably get money from their bank already. Right. If they can't borrow, they might be not solvent, and so they really have no room to borrow. And then it's not clear what firms want to borrow money in this environment because they have to pay that back at some point in the future. So that was where, from the fiscal perspective, the Paycheck Protection Plan was really important. Those loans were more grants than loans. And right. So that money was more I think, effective. So I group it into sort of the asset purchase programs about creating, or the lower interest rates, asset purchase programs to create market functioning or support market functioning, and then lending programs to make sure that credit was still available in the economy, is how I group that.
Okay, so kind of this emergency stabilization, let's keep the gears continuing to turn, and then let's lower interest rates, stimulate demand. Anybody that needs to borrow can borrow that at a cheap rate, are kind of the two buckets.
Right, and then I guess now I think about, you asked me another question there too, is how does that affect the economy, right?
Right.
So, this shock was different than what we saw, say, in the last two recessions, right? In the last two recessions, we had a financial sector shock that bled into the real economy. This time we had a real economy shock that bled into the financial sector. Yep. And so the Fed had to rush to contain that shock to the financial sector so it didn't blow back into the real economy. What we didn't want was some kind of Great Depression situation where we let the financial sector just sort of implode and impede the credit flow for the rest of the economy. So the Fed effectively, I think, managed that process, and we see these markets functioning much more effectively than they were, in March, for example. So I think the Fed was successful basically in preventing things from getting worse. Lowering interest rates has certainly had an impact on housing, for example, right? Housing markets are clearly on fire. And one reason is that interest rates are fairly low. And I will expand on one more. I know we don't have time forever, but we should note that the large-scale asset purchase program, so the quantitative easing, was originally designed to smooth market functioning or improve market functioning. It's not really clear that that's the current rationale, and I think they're moving the rationale, and this was in the minutes, toward this idea that then is more supportive of an accommodative financial environment. And so what they're doing is holding interest rates low by those asset purchase programs. So essentially reducing the term premium or the risk associated with these bonds. So hold interest rates low. And also by pulling off some of those treasuries, you're going to force some portfolio balance effects. So you will force individuals into some other assets. So some people, obviously, if you take away their treasury because of the way they've got their portfolio structure, they need a new treasury, right? They just, they need that particular product with its certain risk and return to fill that portfolio. Other people will search out different kinds of assets.
Right.
So you'll see that change in language going forward.
Yeah. Okay. So part of it's to encourage, think about it as some more risk taking. As treasuries come off the board, you're kind of forcing people into potentially some other assets.
Yes.
But it sounds like, at least initially, kind of the main driver was we have a crisis, a health crisis that obviously affects the real economy, and the Fed's trying to make sure that doesn't turn into a financial crisis affecting the financial system. So that's kind of job one, which they've done. So I guess now my question would be, as these things have happened, as we uh, Congress continues to debate another stimulus package there, the Federal Reserve is doing what it's doing. It's kind of on maybe autopilot, if you want to think about that. Not a lot of new policies coming out. So there's this fiscal cliff that we've heard about, right? We still have high unemployment. The stimulus is run out. I guess the question would be, what kind of shape is the economy in now? There's a lot of money in the financial system at this point, but what kind of shape is the economy in at this point, as far as where you see it?
Right. So it's kind of in many ways all over the place. There's certain sectors that are doing quite well. So we talked about housing, for example, as a sector that has been really a standout sector in this recovery. Other sectors such as leisure and hospitality are being slower to recover, right? So the more closely you're impacted by pandemic and the need for additional social distancing, the worse your sector probably is. And the more pain you're suffering. And the longer this drags out, the more that pain's going to spread to more and more firms. So we know we have double-digit unemployment. We know that initial unemployment claims are still, around 1 million a week, which is still higher than the height of the last downturn. So we know that the situation is fairly grim on many levels, and that's why we think that we really should have more fiscal stimulus, or at least more fiscal support, to extend some of those payments, the enhanced unemployment benefits, and to let people who are just becoming newly unemployed re-enter the work, basically survive while they wait for a new job, right? And the challenge here is that there's not a lot of jobs open right now. Actually, there's quite a few jobs open. It's just that firms aren't really hiring to fill those jobs yet. Until they become more confident. So we're kind of in this limbo, and it would be helpful for the economy to have, I think, continued fiscal support through the back end of this year. Now, whether that's absolutely necessary for growth is a different question. So as we've seen reopenings, as we've seen some sectors of the economy do well, we've also probably having upward pressure on hiring that's kind of soaking up some of the people that are unemployed. And that is not necessarily going to end here just because we've gone over, reduced these unemployment benefits. And so that's kind of the transition point we're in the economy is, there's a lot of bad things going on. There's also some good stuff going on. Can we leverage off that good stuff? The housing's a big one. When you think of housing, that's traditionally a good leading indicator. And there's been a strong rebound in the sector, and I think partially it's because people didn't buy houses for a couple months, partially because there's a big demographic trend in that direction. I don't think you need to tell urban to suburban story to support the housing story right now. You just had to know that the demographics, the millennials moving into their peak earning years and their peak root what it's called root setting, but family bearing years, that they were going to probably demand more single family or owner occupied type of housing products. And that was really creating the fundamental underlying demand that's showing back up here, now that we've got interest rates underway.
Yeah. So just to recap a little bit, what I'm hearing is, one, there's still obviously a lot of people that are unemployed. There's a lot of open positions, but companies are being slow to either bring their people back or hire for those positions based on probably a lot of the uncertainty that's out there. So there's certainly some bad news. There's also some good news. Housing is kind of a silver lining in all this, doing very well. Any other kind of good news that's out there? I mean, I've been reading what you've been writing, and it seems like initially, obviously, pretty pessimistic about what's going on, concerned about what's going on. Lately, if I'm reading between the lines correctly, I would say you've turned a little bit more optimistic just in terms of where we are. So what are some of these other positive stories that are out there?
Right. So I think one place you can look is this IHS market manufacturing report and service report that we had last week, which showed not just a rebound in manufacturing and service activity, but also in associated employment. so that firms were seeing that they had enough demand to start bringing workers back. Investment to saving, excuse me, inventory to sales ratios are very low and have dropped back down. There's probably room for inventory rebuilding through parts of the economy. So you might have noticed that there's certain things that are just hard to get right now. Bicycles, right? Another story I heard was, paddle boards. That wasn't from you, was it? I can't remember. I can't remember who gave me that story.
It was not, but I got another story for you. So we are supporting the real estate market as well. So we just moved into a new house. We got a growing family, and we needed to buy a bigger house, and so we're supporting that. Additionally, it's a little bit bigger house, and so we've got some furniture that we need to buy, and it's just hard to find furniture right now. That's another thing that's on back order. So there's another data point for you.
Yeah, so there's an NBR paper a couple years ago where a home purchase entails another $3,700 of additional spending on average. So you probably felt some of that. So
yeah, I believe that.
Those higher housing activity boosts overall activity. So inventory correction could become a big thing as firms scrambling to produce. We've seen that in the wood products industry right now because firms had looked at the economic environment in March and started to curtail production of wood products. And then the housing market came back and, firms are caught low inventory, mills not operating or not operating fully. And now they're just rushing to try to meet the demand that's out there. So those are a couple places where we're seeing it. Also, COVID cases in the U.S. are coming down. And I don't think, that story has made it out as much as it probably should, is that we're reversing some of these trends from earlier this summer. Social distancing seems to be having an impact. The key is, can we control the virus without reverting back to some kind of really heavy duty lockdowns? I don't think we're likely to get widespread lockdowns again. I don't think there's a lot of political will for that. It's not clear the science supports it quite as much as it did initially. So more rolling, localized lockdowns, increases, decreases, and restrictions, but maybe not what we saw earlier this year. So, there's I think there is some good news out there, and that makes me a little bit optimistic that maybe our pessimism, at least as far as how quickly we can recover, was just too much.
Yeah. Okay. And I want to come back to that point around COVID cases here in the U.S. starting to decline, and maybe the rest of the world, they're starting to see them, especially Europe, tick back up. And so kind of the implications for the U.S. economy versus European economy and the rest of the world, and then that impact, the impacts of that on the U.S. dollar. So I want to come back to that. But one thing that you've touched on so far is kind of the necessary nature of this stimulus and support upfront. You kind of still think it's needed, especially in terms of fiscal stimulus, spending by Congress, spending by the U.S. government. The question that we get a lot of is, I can see how that makes sense, how this is a good thing to do, but how do we pay for it? Aren't we digging ourselves into such a deep hole, that we're never going to be able to get back out of this? The debt's going to run away from us. I was reading, I think it was in the Wall Street Journal today, U.S. economy and a lot of the developed countries around the world have debt levels that are similar to where we were at the end of World War II. And we've had debt levels there, but kind of the situation was a lot different. Demographics were different back then. We've got some really high growth coming out of World War II that helped. We actually had some inflation coming out of that period that helped with the debt situation. So I guess the question would be, how do we dig ourselves out of this hole, and how concerned should we be around the level of debt here in the U.S. and across developed countries around the world?
Right. So I'm going to preface this in saying this is not a new concern, right? This is a long-running concern for as long as I can remember. If you remember the presidential campaign of Ross Perot back in the day, this was a big issue then, and it has never resolved it. It has never become an economic issue. And I think there's a good reason for that is we've probably underestimated the debt bearing capacity of the U.S. economy. That, you know, I don't think, first of all, people forget you can't really go bankrupt. U.S. Treasury, you can't bankrupt U.S. Treasury debt because it's denominated in dollars, and you can always pull, print dollars. What you can do then is end up in an inflationary type of environment. Well, for all the talk of that, we've been in a disinflationary or stable environment for many years now. And it's not just the U.S., it's other countries too. Most developed countries have found themselves in that trap. I think what that's telling you is that there's a lot of excess capacity in the economy that really hasn't been put to work effectively. And until we see that excess capacity used up, the spending, the debt finance spending is not really going to be a problem. It's only when we start to see real pressure on real resources where we see inflation start to emerge, then we have to think, well, maybe we've gone too far. Now,
so am I correct in saying inflation should be our bigger concern than the level of debt?
That's what I would focus more on. Are we getting inflation dynamics developing rather than worrying about the level of debt itself?
Okay. So what would be some of the early warning signals, if you were to say that, in terms of inflation or this excess capacity being used up? Gold's been on a tear lately. Are we seeing signs of inflation?
So that's a good question. So I wrote a Bloomberg article about this, and so it's basically sort of how do you set the stage for inflation, some really interesting kind of inflation dynamics. And you had to have, I think, a couple different pieces fall into place in order to achieve that. One is probably continued fiscal stimulus. Basically keep pumping money in the economy, keep the deficits high. Right?
Yep.
I'm not saying that by itself is going to cause inflation, but if you keep doing that until you get to the point where you actually see some pressure and capacity constraints, that would be the sort of first sign that something is happening. What's been different about the stimulus is that so much of it has been in the form of direct payments to individuals that are going to spend the money rather than running up the deficit for tax cuts that might end up in the hands of wealthier people who have fairly low marginal propensity to consume. So it doesn't end up in spending quite so much. So you have continued fiscal stimulus that really does crank up and keep a fire under spending. So that would be one part of it. Another part of the story is that there'd be some supply constraints. And how do you see those constraints? Maybe productivity is low. Maybe labor force participation is low going forward because we can't get schools and childcares back operating, so we can't get two parents back in the workforce. We only end up with one parent back in the workforce. Maybe you have lower fertility rates, so you slow population growth. You have lower immigration, so you slow population growth. So there's a number of mechanisms by which you can say maybe you have lower productivity growth going forward, and lower, and then by that mechanism, you end up with slower slower supply growth. Okay. So you've got that possibility too. Then you add in the possibility the Federal Reserve basically doesn't just lets inflation sort of rise. That the Federal Reserve basically spent the last 20 years fighting an inflation ghost that never arrived, never rose, never came about. And now they've decided, well, that ghost isn't there, so we're not even going to worry about it. Well, that's the time that maybe you do want to pay attention to it, right? So you get those three things together, and you get some kind of supportive labor dynamic where wages start rising in that environment, and then you can talk about an inflationary kind of environment. I don't think it happens overnight. We didn't see inflation kind of, explode, right? There was actually, at some point, it's kind of when you flip that switch to get to some dynamics that we haven't seen in a long time. Is that possible over the next year or two? I can tell a story. It's certainly a more interesting story now than I've had in 20 years to tell that story. But there's a lot of moving pieces to make that happen. There is a different story though that's from investment perspective fairly relevant, and that's okay, suppose you don't go to that extreme story. All you do is say, okay, the Fed allows inflation to go to 2.5%, stay a little bit higher than we've had recently. Well, at the same time, they're pegging interest rates at 0%, right? Well, then you have a 2.5% negative real rate, and that's going to have implications for the kinds of assets you want to buy. They're probably assets that are real type assets like stocks, property, and housing, which is where we're seeing a lot of interest right now. So, you don't have to go to extremes to make some interesting story here. You just have to have something that's a little bit different than what we've had in the past.
Yeah, no, it's a good point. Follow-on question to that is, I think one of the concerns that's out there is kind of once the genie's out of the bottle, it's really hard to get back into in terms of inflation, right? And so the 70s, we had high inflation, and it took a long time to bring that under control and some really high interest rates. And then, obviously you have your Zimbabwe and Weimar Republic of the world examples that people like to bring up. So question is, how effective, if we do start to get 3, 4, 5% inflation, how effective in your estimation will the Federal Reserve be, or can they be, in terms of getting that back down to around a 2% target?
Well, they can always be effective. You can always make a recession.
Right.
You can always bring down the inflation rate should you want to. So they can do it. It's just sort of, do they continue to have the political will to do so? And again, the key story, one of the key pieces in an inflation story is that they've given up worrying about inflation. They see every increase of inflation as a temporary phenomenon they don't have to worry about, and then just basically ignore it. And then it starts to feed on itself. The reason that they do that is because they perhaps start to say, well, okay, we can't trust these inflation forecasts anymore. We really care about getting unemployment down to 3.5% again. Maybe is not possible in the post-COVID world. And I don't know that for right now. I don't want to say that we should limit our possibilities of what could happen going forward. I don't think the Federal Reserve should do that. I think what you should do is of course, as an investor, you should have a full range of potential opportunities or potential outcomes out there that you're thinking about that are realistic. And I do think at least having somewhat higher inflation is not a crazy outlook. And again, you don't have to go to extremes for it to be have interesting implications.
Yeah, no, we definitely agree with that. I mean, one thing we like to talk about is preparing for multiple possible futures. You don't know which scenario you're going to get, but you should be prepared for some of these different scenarios that could happen. So
right.
It's a good point. I want to switch gears a little bit, and maybe this is back to what you were talking about some of the stimulus payments, direct payments to individuals going to people's personal accounts, checking accounts, savings accounts. Your column most recently with Bloomberg touched on this, and I think this quote was from that article. And basically the quote was, the conventional wisdom hasn't completely processed the potential implications of massive improvements in household balance sheet this year. So can you talk a little bit about what you're observing with individuals, their balance sheets, the strength of those, and then the potential ramifications of that? So just to pull one statistic from that article to tee it up, basically there's been, what you're observing is a $1.3 trillion increase in checkable deposits across the US. And that's not a trivial amount. That's about a 60% increase from where we were before the crisis. So can you talk a little bit about this improvement in household balance sheets that you're seeing, and then potential ramifications, or what's a story that can play out from there?
Right. So earlier this year, and through at least July, we had massive transfer payments from the government in the form of the rebate checks, the PPP, the $600 a week unemployment benefit. And we also had, for part of that time, a real slowdown in spending. The combination of those two things, it meant that people were saving a lot more. And saving rates jumped to 30%. And savings is a flow, or saving is a flow. So every month you save X, that adds up over the months. So I did a sort of a quick calculation, said, okay, it looks like we've saved about $1 trillion more than we had planned to save, right? So this is basically unplanned saving. And it's a little bit different. Some of it was driven by spending less, but other of it was force-fed to us from the government, that income for it. So there's a lot of excess savings sitting out there that's basically unspent. At the same time, people paid down their credit cards. So we saw a drop of about $100 billion in revolving credit. So household finances were helped by having this extra cash lining their bank accounts, having less credit card use. And on top of that, you also have higher stock valuations or at least a rebound in stock valuations and higher housing prices. So I'd say there's a fairly good chance that you had a very large increase in household wealth in the second quarter. And a lot of that household wealth was again, unplanned. It's sitting there in checking accounts. It's potentially hot money. So, what are the implications of that? There's two implications. One is that some of that spending starts to leak out even as we have these reduced payments from the federal government for unemployment insurance. So maybe that helps to compensate some of the downward pull we're going to get from those lower unemployment payments. So that's out there. The other possibility is that you get into this another 6 months, 12 months, you get a vaccine, confidence suddenly jumps, and people want to take that money and put it to use. And when I say put it to use, I mean spend it on stuff they didn't buy last year. So whether there be a car, whether it be a vacation, I posited that maybe we're all going to try to go to Hawaii on the same day, right? And there's some truth to that. We're all going to try to rush to get to some of these experiences that we haven't been able to get to. And so I do think that's an interesting possibility, again, for next year, that people aren't really, I think, processing that potential. There is a lot of excess demand that could come out there fairly quickly. So it's something to watch.
Yeah. Okay. Everybody go to Maui as well, and I'll go to Kauai on that same day.
That's right. That's right.
We're getting short on time. I wanted to make sure to get to the U.S. dollar, and then I'll get to my closing question. But on the U.S. dollar, since basically the crisis has started, the U.S. dollar rallied, and then since then it's been selling off pretty drastically. There's two stories that are out there. One is that the US dollar is done as the reserve currency, and that's why it's declining. The other is this story that's more around the rest of the world is out in front of this from a health perspective, therefore their economy will recover faster, therefore their currencies are doing better. What do you see from the US dollar? Which story do you put more stock in? And then I guess if you want to tie into it, where are things now, where we're starting to see, from a health perspective, things taper off here in the US a little bit, and maybe Europe's ramping up a little bit. How much of that is impacting the dollar? Where do you see the dollar going from here?
Right. So that's the first story, that the dollar is done. I don't think that's true at all. If you remember, just a few months ago, the Federal Reserve had to open up all these swap lines to the rest of the world because there's this huge demand for dollars. That didn't change overnight. For better or for worse, the global financial system is heavily dollarized, and it's not so easy to change that system. So I don't think the story about the dollar being done, that's another story I've heard basically since the 1980s, and probably before that, and it just hasn't played out that way. So that story I put on the back burner. The other story has been the more interesting one, where it did look like Europe had a better handle on COVID, so their economy was going to rebound faster. You saw equity managers, or asset managers, put money into European equities on that bet. For example, you saw weakness in the dollar on that bet, and that's fine. But there's some questions emerging how long that's going to last, and the questions really emerge from the fact that we're seeing COVID cases start to decline in the U.S., but start to rise in the rest of Europe. And you can trade places in this. And getting COVID under control is very difficult to do. Is that, clearly, we've seen once you sort of turn your back on the virus, it starts to get out of hand again. So, that seems to be the case both for Europe and for the U.S. So we could be revisiting that hypothesis that Europe will recover faster because their caseloads could actually start to surpass our caseloads in the not too distant future. So that would be then, a positive for U.S. assets relative to the rest of the world. So that's something to think about as another risk of how conditions could evolve here going forward. And of course, I would be one. Oh, sorry. I'd be remiss if I didn't say, of course, there's still downside risk as well to the U.S. economy. That maybe the end of the extra fiscal support has a bigger impact than we currently anticipate, or I currently anticipate, and that starts to swamp on the other side. So, again, and as you mentioned earlier, you like to make sure you understand all the potential risks out there.
Right. And that actually last point tees up one more question I want to sneak in here, which is, I've been reading you throughout this crisis, and you seem to be more optimistic now than you have been at any point. And so the question would be, do you see more downside risk from here in terms of what the consensus is out there, the stories that people are telling in aggregate? Do you see more downside risk to that consensus, or do you actually see more upside risk?
I tend to think there's more upside risk because there's a lot of, I think, pessimism built into that conventional wisdom. And I understand where that comes from. My point of view is that the U.S. economy is dynamic. Economies by their nature will evolve their way around whatever problems in front of them. And I think we kind of forget that sometimes, that, people will, find a way to be more safely conduct economic activity going forward. And I think that'll eventually have some more positive impacts.
Yeah, got it. Well, this has been great, Tim. I really appreciate it. One more question, which is less of an economic question and more of a personal question. I've been asking everybody, when things get back to normal, whatever that looks like. This is a podcast really about life beyond the crisis. So what are you most excited to either get back to, or what have you become convinced as a result of what we lived through in 2020 that you don't need to put back in your life? What are you going to cut out permanently as a result of this?
So the thing I would like to do is I'd like a vacation. I'd like to go to a warm beach. So I'd like to go to Hawaii. So that's near the top of my list. We had to cancel our vacation over spring break. So I would like that back. Or some equivalent. So that's at the top of my list. As far as things that also I'm not sure I go back to, we have acquired a Peloton, right? So do I go back to paying for a gym membership, or what kind of gym membership do I go back to paying for? So that'd be one sort of thing that's out there. That's changed my behavior somewhat. And I'm sure that if I think about it, there's probably 10 other little things like that add up to something significant. Now, I say these things, but I also will tell people the behavior is stickier than you think. I did say earlier in this crisis, I don't think I'm going to go to Costco again. I'll just order online. Well, sure enough, I'm showing up at Costco again and buying in person. So, we'll see.
Yeah. Well, good answer. Thank you. Yeah, right. Good answers. Thank you again for your time. I think we covered a lot of important ground today, so I appreciate it. And for anyone that's interested in what the Federal Reserve is doing, where the economy is, and wants to stay up to date, again, highly recommend either reading Tim's column in Bloomberg or reading his blog, FedWatch blog as well. Both excellent resources. So thanks again, Tim, and good talking to you today.
Good talking to you too, Isaac.